In a previous video, we discussed what is a dividend yield, but let's refresh it. In short, if the price of a share is $100 and the yearly dividend is $4, then the dividend yield is 4%. Now, it might seem logical to look for the highest dividend paying stocks because a 10% dividend yield sounds better than a 3% dividend yield. But this is a huge mistake. In order to understand why this is very risky, we need to understand what determines the dividend yield. The dividend yield is determined by the price of the stock. If the price of the stock goes down, the dividend yield goes up. For example, if the stock price is $100 and the dividend is $4, it's a 4% dividend yield. But if the stock price goes down to $50, the dividend yield will be 8%. And of course, if the stock price goes up, the dividend yield goes down. If the same stock goes up to $200, the dividend yield will be 2%. But why is this important? It's important because the price of the stock is created by the collective voting of thousands of investors. If more people want to buy the stock because they think that it's a good investment, the price of the stock goes up. If more people want to sell the stock because they think that something is wrong with the company, the price of the stock goes down and the dividend yield goes up. So a higher dividend yield usually means that most of the investors think that something is wrong with the company, therefore many of them sold the stock. So if you see a 10% dividend yield, it doesn't mean that nobody else noticed it. It means that probably something is wrong with the company. However, most of the time the market is efficient, which means that investors price the stocks properly, most of the time, but not always. It's possible to find stocks that have a higher dividend yield, higher than average. For example, I bought Altria with an 8% dividend yield when the market average was around 2%. But the dividend yield itself is not enough to know if it's a risky investment or not. The dividend yield is only one component of picking stocks, and you should never make an investment decision based on looking at only the dividend yield. If you want to buy stocks that have a higher dividend yield, you need to look into the balance sheet of the company. How is the company doing? How is the revenue? How is the debt? We need to check many details to know if it's a stock that is undervalued or there is a reason for the higher dividend yield. Sometimes there is no rational reason because investors are not rational all the time, but most of the time the market is rational. One thing is for sure, stocks with the highest dividend yield are the riskiest investments. Usually I buy dividend paying stocks with a dividend yield between 3% and 6%. Sometimes I make exceptions like with Altria, but you really need to be sure that you know what you are doing when you buy a stock with a high dividend yield.